Hi, everyone. This is Alex Epstein, host of Power Hour, and this week is another Best of Power Hour. On this week's Best of Power Hour, we have an episode with Michael Lynch on the economics of oil prices. Michael, or Mike, as I call him, was one of the first guests on Power Hour and had done one of the initial episode we did was on peak oil, and one thing that was notable about that was Mike was predicting that long-term oil prices would be between $50 and $70. And at the time I had him on, they were much higher, and so 50 to 70 seemed impossible. And then he was really right about that. And so later on in the episode you're going to hear today, he talked about just more broadly the economics of oil prices, how he thinks about them, what he expects for the future. I'm a really big fan of Mike's. He has a really good understanding of energy economics and just a vast amount of specific knowledge. So I am always glad to have him on the show and get his take, and I hope you enjoy it as well. Also, if you haven't yet pre-ordered your copy of the new Moral Case for Fossil Fuels, just go to Moral Case for Fossil Fuels, or just type that in on Amazon, Moral Case for Fossil Fuels Revised and Expanded, and pre-order your copy. I believe you don't get charged till it comes out, so no risk right now. Okay, enjoy the episode.
Power Hour. Coal. Oil. Natural gas. Power Hour, the show where today's top energy experts break down today's top energy issues. No sound bites, no talking points, no nonsense, no BS, no softball questions, no vagueness, just in-depth analysis and ruthless clarity. Power Hour. Here's your host, Alex Epstein.
Welcome to Power Hour. I'm your host, Alex Epstein. It has been a while since we've done Power Hour. Still nowhere near back on the weekly schedule, but once in a while I correspond with someone or talk to someone that I think, gosh, this is why we have Power Hour in the first place. And this week I have just that person. I actually recorded this interview about 2 weeks ago, but it is still super relevant. It's about the question, what is causing the price of oil, and what should we expect for the future price of oil? And the guest is Michael Lynch. For those of you who might remember, Michael Lynch was the second ever guest on Power Hour, and years ago talked about how he believed that the price of oil was artificially high, or at least bound to go much lower, and he was considered a crank for believing that. This was even before the Shale Revolution was as widely known as it is today. Shale Revolution, also known as in simplified form as fracking. And as Mike will tell us, he was called insane by people, and yet time and time again he's been right about the nature of the oil markets, and more importantly than that, he has very, very clear explanations. So Mike is my favorite energy economist that I'm aware of. He does great stuff. He gives fascinating explanations, so I thought I'd bring him on to answer this question, what is going on with the price of oil? So I hope you enjoy it, and join us with Mike Lynch on the other side.
Power Hour, because what you don't know about energy can kill you. Here's Alex Epstein.
I'm very, very happy to welcome back Michael Lynch, President of Strategic Economic and Energy Research. First of all, Mike, is that the exact right way to say it?
No, sorry, it's Energy and Economic Research.
Energy and Economic Research. Well, my part of this podcast began on the wrong foot, but don't worry, listeners, it's going to get really good. So Mike was on the show in February 2011. I was a completely unknown podcast host, and my friend Rob Bradley Jr. happened to know Mike Lynch, whom I had read write two really great columns in the New York Times, which, you know, from the energy perspective of this show is oxymoronic. So I didn't think I could get this superstar, but Rob had good connections, and Mike deigned to be on the show. I swear this is how I felt at the time. I thought there's no chance this guy will be on this podcast, but he's very accessible. And those of you who remember episode 2 may remember that back then Mike was talking about, I believe, the possibility of $70 a barrel, even $50 a barrel oil, which seemed crazy to many people then. And then as prices went above 100, made it seem like, I didn't actually think this, but I think many would have said, well, obviously, we're past that. That's never going to happen. And then prices started falling, and I started thinking, well, it might be a good time to talk to him again. So, Mike, welcome back to Power Hour.
Thanks a lot, and thanks for the praise, Alex.
Yeah, no, I'm a fan, and I definitely think you should check out his Forbes column. I think there's a lot of very valuable free advice for oil companies. I know a lot of industry people listen to this podcast. So last time we discussed the fallacies of peak oil. This is something that I have discussed in my book. We've discussed on a bunch of shows. I'm more interested in the positives of oil forecasting. But let's go back to February 2011. What was it that made other people think that prices were only going to go up, and what was it that made you think they might go down even to $50?
Well, one thing is that people tend to not think about where the price is. They tend to start with the current price and then think about the future trend. So very few people will say at $100, oh, the price is now high and should go down, or at $40 it's low and should go up. They tend to, just start with the actual price and look out from there. And typically, people have tended to forecast higher prices just because of this belief that, we're running out, the easy oil is gone, costs are rising. After the 1998 price collapse, you had about 5 or 6 years where people forecast long-term prices being flat. And of course, that was when they started going up, which is another story entirely. But the tendency of people is to be very general in their thinking about prices, and to just think about the problems and especially on the demand side, where how on earth can you meet rising demand? And so they see ever tightening markets in the future, and thus they tend to believe in higher prices.
Okay, well, that leads to the question, what's wrong with that?
Well, historically, mineral prices have not tended to rise. You'll hear people say, oh, the Stone Age didn't end because we ran out of stones, but the Bronze Age didn't end because we ran out of copper either. The empirical research has shown that over the very long term, you don't get a lot of change in mineral and energy prices relative to inflation, except where you have things like price controls or unusual events. And what you tend to see is much more cyclical price moves up and down. But the amazing thing is you tend not to see people interpreting them as cyclical moves. That is, there's a lot of people who want to say, oh, this is a new norm, a new paradigm. Prices won't go down. It's a little bit like you see in the stock market, or the great tulip bubble and the .com bubble and so forth, where there's a lot of exuberance, some rational and some irrational. But it's simply astonishing how even when oil prices are high, most people will be convinced that they simply cannot go down. When I was at OPEC about 3 years ago at a big conference, and the video's online actually, I'll send you the link, I predicted $50 to $60 in the long term, and the moderator thought I was joking. And, $50 to $60 is still well above the historical norm for prices. But I think there's just a blindness in the combination of wishful thinking and a neo-Malthusian pessimism about resources that leads people to expect ever higher prices.
How much of this has to do with beliefs about the ultimate amount of just what we can call hydrocarbon matter in the earth? I remember one of the things about one of your Times columns that struck me was that you talked about oil existing underground, not necessarily in usable form, but in raw form, in at least 10 trillion barrels, and I think it's quite a bit more than that. And I think people just think, they always think, well, we must be near the point of quote running out. So any given level of barrel production per day seems like it's got to be near the top.
Yeah, and it's amazing because you get, I mean, the peak oil people are the most extreme manifestation. But mainstream geologists, when they talk about the amount of oil resources, they talk about what's available now. They generally don't want to say what is the total resource, what are we going to recover in the future. They say what can we get now with current technology, current economics, current infrastructure, and so forth. And those numbers just keep going up and up. And again, you sort of get people saying, well, they couldn't possibly keep going up. And when you say, well, if the average recovery factor for conventional oil is 35%, that doesn't seem like a very strict ceiling. And I think this gets somewhat into how can technology continue to advance? Obviously, we must know everything now or everything that matters. And you actually see that more or less explicitly in some of the writings. William Pike, the geologist, had a great column, and he said, if you pick up an old catalog, you'll see a lot of basic tools that are the same as people used 75 years ago, and yet we have computer controls, and the alloys are so different, that the actual operational efficiency is just phenomenally different these days.
So in terms of then, as you mentioned the cycles, how do the cycles work, broadly speaking?
Broadly speaking, most of the cycles seem to be up, followed by return to normalcy. Usually, you either get something like a supply disruption due to war or a revolution, that sort of thing, or occasionally a demand boom. Which is kind of harder because you don't usually get a huge sharp increase in demand. But wartime, like World War II, can do that, can cause that kind of demand boom. But demand pressures, and then eventually the supply side catches up, and the prices tend to decline more gradually than they went up. And you see this actually in other minerals besides oil.
What's a good analogy in other minerals?
Oh, like steel prices. Steel prices shoot up during wartime because everybody's building weapons. But also they collapsed. Almost all minerals collapsed during the Depression. The prices just dropped very sharply because industries were not. That's kind of the reverse of the wartime supply disruption. That would be a demand disruption.
Well, one thing people might counter as well is can't you recycle steel, whereas oil is non-renewable?
That's a good point. But when you're recycling steel, it's kind of like saying, this is a low grade or relatively high grade ore resource that we're using, as opposed to drilling into the ground. For iron ore, in theory, even if you weren't recycling the steel, you would still see investment going into into the mining sector. And if oil resources were much more constrained, the way the peak oil people claim, then that would be a factor. I mean, the fact that you can't really recycle the oil, you can produce it. Ethanol, for example, you can produce liquid fuels and fuels from natural gas, but it's very expensive, and I don't think it's that important a topic of discussion.
So in terms of, let's just say, the story of, so in 2008 we had these very, very high prices. What's the story of supply and demand dynamics for the last 10 years? Because we've seen such dramatic activity over then, so I think it would be helpful for people to hear what are the actual dynamics versus, I think what we often hear is just something very oversimplified, such as, well, there are all these Chinese drivers, and therefore the price has to go up and up and up.
Yeah, actually, it's very funny. If you go back to late 2003, people were predicting falling prices in 2004 and a weak market, and OPEC actually had a meeting, and they planned to cut quotas. And then you had, the strongest demand growth in history, I think, in terms of barrels per day, fueled partly by China, but also the U.S., combined with production problems in Venezuela, Iraq from the invasion. And From there, you had relatively good demand growth in China for a few years and globally. But at the same time, you had the problems like Katrina, which was caused a lot of damage to offshore installations and the support industry in the Gulf of Mexico. But also we had the loss of Nigerian oil from rebel activity, and then the Arab Spring, which took out Libyan oil and the Syrian oil, which is not that big a deal. But it was a little bit like being nibbled to death by ducks. So you had on the supply side a lot of constraints. You still had growth in places like Russia. Colombia returned to growth. So you were getting some offset, and the Saudis pumped more or less depending on markets. The price spike in 2008, I would have to say, was kind of a momentum-driven thing, where markets had been kind of tight. People thought they would get tighter, and everybody just started buying in until they stopped. And then after the price collapsed in 2008, OPEC stepped in for the first time in years and said, okay, cut production, brought prices back up. And then we had the Arab Spring, a more or less normal demand levels, but serious supply constraints. And Libyan oil is very high quality, so that had an outsized impact on the market, the loss of oil from Libya. And then ultimately we got into the past 3 years sort of this surge in U.S. tight oil production, which offset the loss for starting about 18 months ago, I guess, of Iranian oil because of sanctions. And so the thing is, this summer, I think the trigger was people saw a market that was in balance. They saw surging U.S. oil production, possibility of a return of Iranian oil production, but then economic weakness in Germany and China, which was more than people expected. So all of a sudden you had rising inventories and the prospects that they would continue to rise out into the future unless OPEC acted. And OPEC chose not to act, and that gave us the lower prices, which seem to have settled around $50 right now.
Yeah, well, that's really interesting to hear that perspective, because it's interesting how it just seems like at every stage, every year, the current price seems to be assumed to be permanent or an indication of permanence. And as you're telling it, it seems like, okay, well, there are these things that can be expected to abate, such as, a given supplier being off the market. Well, it'll probably be back on the market at some point. What determines, this is a broad question, but among forecasters, what are different people giving weight to that causes very different forecasts?
That's a good question. Historically, oil companies would always try to be very conservative because they didn't want to get caught out if prices went down. So they would take the current price or even a 3-year average price and minus 25% as a hurdle rate. Bankers usually were more conservative because they were funding things. Now you have bankers, some of them who are trading commodities, and so they may be a little more extreme, shall we say. What I've seen, for the most part, is you have people saying, well, almost any oil price is possible, so it could go to $20 if surpluses build too much. People saying, well, we think the market will tighten and that the industry can't respond, so prices have to soar. And since they think 100 was normal, then 200 must be the new normal. And that's not very credible, frankly. But a lot of it is, people not saying essentially what is the supply-demand balance, but, kind of what is the psychology of the market and how does that interact with the supply-demand balance to yield price expectations. I tend to try to make the argument that traders get up every morning and they don't think at all about the history of the oil market. They look at the current price and today's news, and that decides whether the price goes up or down on a given day. And only occasionally, as last summer, do people start to say, the trends don't look good. In this case, the trends are very bearish and the price goes down. So the notion, if you go back and look at inventory levels or supply demand balances or surplus capacity in OPEC, what you find is those things are very poor predictors of price in the short term, that is on the course of, say, a month, a year, because there's just so many other factors and expectations that come into play.
Are they good longer-term predictors?
I'm sorry?
Oh, you said they're not good short-term predictors.
Oh.
Are they good longer-term predictors?
Well, yes and no. The big problem is when you think about, inventory behavior is more short-term. The supply-demand balance, in theory, is long-term. And the main explanatory variable should be the long-run marginal cost of production, which is hard to figure out. A, B, it's policy-driven. And I'm developing for my book, a sort of a model using supply curves. And the argument would be in the early 70s, you had a lot of cheap oil, and all the expansion was coming in the cheap areas in the Middle East. And when some of those countries said, let's stop expanding production, you basically shortened the supply curve, and all of a sudden you're drilling in places like Colombia and Argentina instead of Iran and Iraq. And that drives the cost up and the price. On the other hand, if countries like Iran, Venezuela open up the way Iraq did, then the supply curve lengthens, and you get much lower prices in the long term. But there's a lot of policy intervention that most of it not very well informed, shall we say, that determines exactly how much supply is available for investment and development.
So when you talk about the supply-demand balance, in what form does this actually exist for the purposes of a researcher to study day by day?
Well, I guess the question would be in classical economics, and this is the kind of modeling I did 40-some years ago. 30-some years ago. You would look at supply and demand trends, and if supply didn't seem capable of keeping up with demand at a given level, then you would assume that prices would go up to provide more revenue to develop more supply. And in a model, if you had a model that worked that way, you would show it as sort of falling inventories because of insufficient supply, raising the price. But in the long run, it's mainly is there enough supply coming online? And the biggest problem there is if you look at any given price, then you have to figure out, okay, how much investment is that going to yield, and where? If the investment is in Colombia instead of Iraq, you get very different production outcomes. This is why it's so hard to predict the supply of oil. So if you essentially assume a fairly open, benign investment environment for the upstream oil industry, you would expect a much lower price. You would get a lot more oil at any given price. And then the demand side, price matters, but economic growth tends to be dominant in the sense that there's so many places in the world where it's a question of can they afford the oil, not so much is it $50 or $75 a barrel. So the demand side, unfortunately, most people tend to leave out the price when they almost completely when they forecast demand. It seems they'll change their price forecast and leave the demand forecast unchanged. But demand is going to be driven by the fact that oil, aside from being moral, as one recent author said, oil use is very efficient in a lot of applications, and you can't get away from that just by saying the price changes 20%, or people put on carbon taxes or something. You're still not going to ride a bicycle to the emergency room.
But bunch of questions, but just to follow up on that one, in terms of, what is the actual? So, I can see supply and demand reflected by you can monitor how many barrels are actually being purchased per day, and you can monitor the prices. But how are you monitoring demand apart from the point at which it reaches equilibrium and barrels are actually sold? Like, what is demand independent of that?
You mean in terms of the data?
Yeah, like when people say, well, I just always find it confusing when people talk about how demand is higher than supply, but I mean in practice they
Yeah.
equilibrate.
Yeah, and they usually do so through inventories. And there's unfortunately a lot of play in the system. There's usually 1 or 2 million barrels a day discrepancy in the data, but when you look at production, consumption, and inventory change, it should zero out, and it never does, and it never comes close except by accident. So you can reach a point where you see that demand is stronger than supply, and inventories are falling. And at that point, you would expect that prices would go up, especially if it appears that OPEC is not going to raise production, or especially the Saudis, or if they're already producing flat out. And the classic case was the year 2000. Demand was very strong. The price collapse in 1998 meant that non-OPEC supply was weak. And so the market was actually extremely tight that year. It was sort of the first, or I'll say the second post-'70s price increase that was driven solely by market factors, not political factors. But the price only went to about $30, so it wasn't extreme. And so that's the big trick there, though, is that the demand, because the demand data tends to be so bad in much of the world, you often don't have a great sense of what the real supply-demand balance is, except by looking at inventories. And even there, about half of the world's inventories are not reported in any meaningful way. Places like India, China, Brazil, we don't have good data there. So you're sort of watching a lot of secondary variables, like, are people buying tankers to store oil? That means that inventories are too high. Is oil suddenly flooding the U.S. market? Maybe that implies that the Asian markets are oversupplied, even though we don't have data on the inventory. You can kind of try to guesstimate it based on that, but it's a very imprecise science.
All right, I want to move now to the shale energy boom. You've heard a lot of different narratives on this, including, at one extreme, people say, well, this should have never happened because prices were, inflated all the way to this is just, this is going to end up being super cheap to drill because prices are going to go above $200 a barrel. Can you give us your sense of the economics that began the boom and then the economics today?
I would say it was not really economics that began the boom so much as entrepreneurial spirit. George Mitchell saying, maybe we can do this, and fiddling with it for years until he figured out how to produce this stuff efficiently, the natural gas down in the Barnett. And once he figured out that, I think there was just a momentum that could not be stopped. If the price of oil had not been $100, you would not have seen as much drilling in places like the Bakken. You would have seen a lot more experimenting to get the optimal production rates and costs. But when the prices were high, people knew they could drill even pretty lousy wells and still make money. So that encouraged people, who, shall we say, were not quite as expert at producing from shale as some of the old timers. Now, what you've seen, though, is as things have spread, because the shale, it's a lot more, I don't know, idiosyncratic, I guess, than conventional oil, in the sense that, you really care about flow rates and fracturing and so forth. And so each shale is different, and even in different areas. So there's a lot of experimentation that goes on. And when you look at places where people have only just started producing, like the Utica, for example, or the granite walls, you don't have a good sense of where we're going to be in 4 or 5 years based on initial results. You know they'll be better, but you don't know how much. And, what we've been seeing is people have continually made significant improvements on the natural gas side, massively increasing the amount of gas they get per well, cutting drilling times, reducing, crew needs and so forth, so that the price of gas, natural gas, it's awfully cold in much of the U.S., not in California maybe, but the rest of us are freezing our little booties off. And the price of gas is under $3, which, if you'd said that even 2 years ago, people would have thought you were insane. Will oil do that? I think possibly, maybe not quite such phenomenal results, which would be kind of the equivalent of, profitable shale oil at, $25 a barrel. But I think what you'll see is right now, the worst of the wells and the least efficient drillers, the worst 10 to 20% will just drop off. But that won't affect volumes as much because those were the worst. You'll get what the industry calls high grading. That is, people go after the most attractive prospects. So the average production per well goes up just from that. But also you'll have people continuing to improve the costs to where I think what we'll see at, $55 a barrel is that the big plays like the Bakken and the Permian, the Eagle Ford, you'll get continued production growth, a bit more muted, but a lot of concentration there. And then some of the outlying plays like Granite Walsh, maybe people will tend to focus on experimenting first until they really get it right before they go whole hog into major drilling programs.
If it can be generalized, what is the industry's cost or price expectation? You had some, I think I know you do some form of energy stand-up comedy. I've never been there in person to see it, and it's not available on the web to my knowledge. But I saw you had a joke about how, which is amazing that something can not be captured on the web. Must not be controversial enough. But you talked about, people forget that it's a boom and bust industry, and they think it's a boom and boom industry, and that certainly, I could see that mentality. How much of that mentality has been on display in the industry over the last several years, leading into this fall in prices, which seems unexpected to most?
Yeah, I used to joke years ago going down to Texas and say, remember the bumper sticker in the 80s, God, give me one more boom and I promise I won't screw it up. Well, guys, are you screwing it up now? And I said, maybe you should all invest in bumper stickers as a diversification. You saw when the prices first started going up 10 years ago, the big companies especially said, we are going to exercise capital discipline. We do not want to drive our cost up and just lose all the extra revenue to higher costs. That didn't last too long because, people start poaching your people and your equipment, and you got to respond. So you had, especially with the small companies, you had, shall we say, the irrational exuberance where they went into debt seriously. And Chesapeake Energy is probably the most egregious example where McClendon convinced himself gas prices couldn't go down because his costs were high, and he borrowed a lot of money at the highest price. And, now he's not with the company anymore. Continental Resources is somewhat similar. Some people say Exxon's purchase of XTO was a case of buying at the high. But the big companies tend to have more money and deeper pockets. They have not built up their debt quite as much as the very small and sort of small medium companies. And that, I think, was a kind of a big mistake. If people are paying $15-20 an hour for Burger King workers in North Dakota, you can understand that means that the drilling hands are going to make a lot more. And people thought at $100, well, that's okay. Our revenue will cover it. And now you're seeing a lot of these guys in trouble. And I think you'll see a bunch of them go under and be snapped up and so forth. So you did have a mix of the industry saying, look, we know we're not running out, which was good. And prices will go down again for, they would say that for at least the first few years of high prices. And then you started to see it move back. I mean, I mentioned the OPEC talk I gave on the panel was the CEO of the French company Total. And, he said, well, one doesn't like to call someone an idiot, but cost of $100 a barrel, and if the price goes below that, people will invest less and the price will go back up. And that, I think, is kind of, the wishful thinking fallacy that a lot of executives get into, not so much the Exxons and Shells, but certainly some of the smaller companies, and Total among the big companies may be the most egregious.
Just incidentally, was that the CEO who died recently?
Yes, he died, Christophe de Margerie, who died in the plane crash in Moscow.
In the plane crash.
And I had nothing to do with it.
Yeah.
A number of people who disagreed with me have died, usually old age. So.
Matt Simmons. Where were you when that happened?
It's funny because there were people suggesting either that BP or the CIA killed him. And I was a little surprised since I was one of his harshest critics. I never found anyone suggesting I did it, but I probably shouldn't say that. Matt, Matt and I could be more or less cordial. I didn't dislike him as a person. His work was pretty awful, but it's, I don't think his death was anything mysterious, unfortunately. Sad for his family and friends, and frankly, we're all getting older, Alex.
Yeah, tell me about it. So let's see. Well, speaking of critics, I'm curious about John Brown's views, because I was on a podcast the other day, and one of John Brown's employees, or at least he called himself an employee of John Brown. Who knows what level that means you're at. But supposedly he was calling John Brown prescient in terms of John Brown saw that once we hit the late 90s, resource prices would permanently go up. And he was claiming this last week. So what is this argument? Are you familiar? I just didn't even really know this argument.
I had not heard that. Okay, people... Bob Horton, who was, I think, the immediate predecessor or the predecessor before of John Brown, he back in the late 80s said, we're on the verge of higher prices, not sharply higher prices, but rising prices. And he increased BP's debt load, thinking the higher cash flow would cover it. So it's possible John Brown did. I have to admit, I know a lot of people who claim to have seen, this or that, and to have been at Woodstock and fought for the French resistance. And probably, I think if you go into any bar in America and you find an attractive woman, there's a man saying, yeah, honey, I was on SEAL Team 6. The question is, did he know? And this is what the peak oil people often get wrong, is they've been saying higher prices for 25 years or, are imminent. And they said in 10 years ago, look, see, we predicted this, but they didn't predict the invasion of Iraq, the liberation of Iraq, or the strike in Venezuela, or all the other things that took oil off the market. They predicted problems in the normal production of oil, which did not actually occur. So it's partly a question of causality. The other thing, though, is John Brown came under criticism because after the 98 price collapse, he said he was under pressure from Wall Street and London the city to have higher profitability. The industry over the long term has had relatively mediocre rates of return. And so he said everybody has to improve their profitability in this corporation, and that supposedly is why you had so many refinery accidents and the BP Macondo disasters. People felt under sharp pressure to keep costs down, which doesn't jibe with the notion that, we're going to have higher prices in the future. So I don't know. I haven't heard that. I'll have to check with you later.
I'll have to look that up. I mean, this is definitely a perspective from someone who says we're running out of oil and wants funding for his solar initiatives. So let's see. I have a broader question about. Let me just think if there's anything left to cover with shale. So it sounds like one thing that's being underestimated, and that seems to be underestimated a lot in what I would call resource creation, is just the ability of people to lower costs. And yet you hear about it in say, solar. You hear, prices are plummeting, even if it's a market glut. That proves, the innovator, if it's solar, but if it's oil, well, shale or oil sands, they have this absolute price ceiling, and we could never get below that. And how does that make any sense?
And that's a fallacy. If you go back to the 70s, it was assume oil and gas prices rise forever and solar costs come down. Therefore, the crossover point is only 8 years out. And if you say, well, assume that oil and gas prices are flat, then the break-even point is much further out. And that's one reason why a lot of the schemes in the 70s and 80s didn't pan out. Why we don't have we don't have decent electric cars, competitive electric cars, at this point. And because shale oil and gas, that's the kind of thing which is making people crazy, because on the one hand, they say, well, hydraulic fracturing's around forever. On the other hand, people are getting a lot better at it. And what I saw when I looked around at some of the companies is people talking about 10 to 20% improvements per year, either in productivity or in cost reductions, or some combination thereof. So the costs were coming down, similar to the heyday of the best photovoltaic cost improvement years. It definitely means in the longer run, the competitiveness of solar, to a lesser extent wind with natural gas for power generation is much further out than most people think.
To a lesser extent wind, because wind is going to be less competitive than solar, or more competitive than solar?
I think wind is more competitive because wind is sort of concentrated solar. So a good wind site, people put up solar in my neighborhood, in Massachusetts, and this is not an optimal place for solar, but nobody puts up a windmill in their backyard. The solar is here because of the subsidies. Wind, gets subsidies, but people put it up in places where there's good wind power. So I think that's the big difference.
Interesting. So this is going to be a slightly weird question, but what do you do every day?
Well, let's see. I spend about 20 minutes with the cat. My daughter's cat, who's very demanding. I spend a lot of time reading what's out on the, what other people are writing, but also I spend a lot of time trying to come up with data from different places and put it together into a coherent picture. The last couple of years I've been doing, on the book. And what I've done in my career, there's been cases where I find if you really drill down, there's a lot of, we'll say, low-grade ore, but you can refine it and get some insight. I'll just give you an example. Back in the 90s, people said, Russian oil production is very expensive. And I looked at 3 different sets of data and did calculations with them, and in each case came up with a conclusion that, no, the cost of production is about $4 a barrel, that people are just not reading people are just looking at things like investment numbers in rubles and not thinking about, okay, what does that mean in dollars per barrel, that sort of thing. And that led me to conclude that when there would be a Russian oil boom, a new Russian oil boom, when they fixed all the fiscal problems. So that's the kind of thing I do, and I generate reports for clients, and obviously blog for Forbes, and I keep trying to work on some of my comedy, although I need to. I haven't done an energy economics stand-up for a couple of years. It's always been at sort of professional conferences. That's why you don't see it on the web. But maybe I'll get something filmed and up on the web sometime soon.
I'll try to get the Speakers Bureau to make me coincide with one of your appearances so I can get an inside preview. Well, you mentioned, so in terms of your consulting work, it's at energyseer.com, which is energy, SEER.com, right?
Yes, that's right.
And in terms of the book, so in 2011, we talked, and you proved quite prescient on prices, at least from now until then. But you also said you had an upcoming book, I think, later that year. So how did that book's release go?
Well, that's the book I'm working on now. Yeah, it turns out I'm kind of like BP. I'm always a day late and a dollar short. It took me a long time to find a publisher. I think partly because people were looking at more at peak oil, and there'd been a number of books, so many books on oil that it was hard to convince somebody that there was room for another one. And then just some family things the past couple of years have preoccupied me. All cleared up now, knock on wood. So I'm now crunching numbers and calculating decline rates and economic cost curves and things like that. And my book will be very dense with data and graphs.
So lots of data and graphs, but it'll be super readable,
yeah.
Right?
Yes, I think so. I mean, about 2/3 of it will be more general, and we'll talk about historical experience and things like separating out sales pitches for new technologies from realistic possibilities, that sort of thing. And there will be almost textbook discussion about the economics of oil, but I think which will be more interesting to the more technical reader. But I think a good part of it will be entertaining as people look down and see the oil industry follies, shall we say, the energy policy follies of the last 40 years.
Interesting. Well, it'll be interesting to see which companies buy a copy for every employee and which don't.
Yeah, I have to tell you, back in 1992, I wrote a paper called "The Fog of Commerce: The Failure of Long-Term Oil Market Forecasting." And the head of planning at Exxon sent copies to everybody in his department. And the Saudi oil minister supposedly did the same, but I didn't get a lot of consulting business out of it, I guess. I mean, part of the problem was, as a friend at BP said, we know all this stuff now. You've convinced us. So what should we pay you for? Do something we can pay you for.
Yeah, well, this is one of the rules of, I think, these kinds of professions is, tell people what to do but not how to do it. You gave away everything.
Yeah, and it's also I don't need to go to Exxon to explain energy economics to most of the people there. But there are a lot of banks and airlines. I mean, the airlines bought into peak oil in a big way, which is just so silly. And we'll see if as a one-man operation, essentially, how much of my time will be spent going out and explaining the basics to people outside the oil industry.
Interesting. Well, yeah, it can be it can be scary for them, particularly I think for anyone. Just when you're in the middle of a given price, it seems like there's no reality almost to the idea that it could go down.
Yes, And I'll tell you, a classic case 20 years ago, in terms of policymakers, 20 years ago, a big conference at MIT, and at one of the sessions, somebody said, okay, yesterday the automotive engineers said the internal combustion engine can be made much cleaner and much more efficient. And today we were told by the oil experts that there's lots of oil, don't worry. But last night at dinner, we had a government official say we have to switch to electric vehicles because gasoline cars are too dirty and we're running out of oil. Why is there this disconnect? And somebody said, well, you notice that the government official is not here listening to any of the experts. And this is a big problem, is that there's way too many people out there who think they know what's going on. They've heard certain sayings, truisms, urban legends even, and they think they know what's going on, and they are sometimes shocked to find out that, oh my God, the price can actually go down, for example.
Yeah, well, it's good to have the expert with a big picture perspective and who can actually explain it. So with that, Mike, thanks so much for being on.
No, it's been a pleasure, Alex. I've enjoyed it.
Thanks again to Michael Lynch for being on the show. We covered most of what I wanted to cover. Just another perspective on something I talk about a lot when I talk about Lynch, which is that I really like his thinking methods. If you listen to most people on the news talk about the price of oil, they'll do it in a very disintegrated way. And by that I mean they'll just give some very oversimplified explanation that doesn't take into account all of the kind of different dynamics going on. Geopolitical dynamics, just physical dynamics, economic dynamics. And one thing when I talk to Mike and I listen to Mike that strikes me is he just has a very, very firm grasp on seemingly all the relevant things that determine the price. So even when he's wrong, and he will admit when he's wrong, and he'll acknowledge that price forecasting is incredibly difficult, he can give plausible explanations of what was wrong in his prediction versus somebody who just says, oh, I think oil will go up to $90 a barrel, and they just say that, and then you're supposed to have confidence in it because they're an expert. This is something where the dynamics are very complicated, and then the magnitude of each one is not knowable in advance. So it's important to include as many dynamics as you can in your forecasts. Explain those to people, and then explain what happens as reality actually runs its course. So I think it's a really good type of thinking method to use in this field and certainly in other fields, and it's definitely conspicuously not on display in discussions of issues like fossil fuels' impact on climate. So, what else is going on? Well, we haven't been doing many power hours, as you know, if you listen to the show, or if you can see the intervals. We haven't done any power surges in a while. I don't have a great reason for that, except that we're still trying to figure out what format makes the most sense. I've tried the live format, which I like a lot. It's just a matter of getting something consistently that really works. The original genesis of Power Hour was I wanted to meet all these different people and ask them questions, and this podcast was a great way to do that. Now, there are certainly more people in the energy field that we haven't interviewed. There are people that we can re-interview, such as Mike Lynch. We can maybe focus more on the topic of the week, but it's just a matter of there's something really great about this podcast. At least that's the feedback I get. It's just a matter of figuring out what the right format is. So if you have any input on that, of course, feel free to email me at alex@industrialprogress.net. One thing I've been thinking of that definitely coincides with my own interests is starting to cover other aspects of industrial progress, not just energy, but the other industries that depend on energy. Of course, every industry depends on energy, but in particular, the types of industries that are attacked for being very high development industries, such as the chemical industry, agriculture, forestry, mining, aquaculture, because in each of these industries, there's this huge potential to do really cool things, and there's lots of opposition by so-called environmentalists. So I think just as we've told the story about energy on this show and explored it in a lot of depth, so there's a lot to say about these other fields. And unlike energy, where I have a good amount of expertise coming in, these other fields I know much less about. I understand the basic principles involved, but I think, part of my motivation is I will be fascinated to just hear from, say, the expert in aquaculture who can tell us, hey, you'd be able to get fish this cheaply if only it weren't for this technophobic opposition. So I think there's lots of stuff going on there. Again, if you have input, you can email me at alex@industrialprogress.net. Other stuff, the book is going really well. You can get your copies at moralcaseforfossilfuels.com. I'm speaking about once a week these days, so that's a lot of fun. A lot of time on the road, getting to interact with very, very interesting kinds of audiences, hearing about college students' reactions to it, people in industry's reaction to it, think tanks' reaction to it. So that's just all really interesting stuff. And if you want to spread the word, we've found that just spreading the book is super effective. So again, moralcaseforfossilfuels.com. All right. Well, as I said, I don't know when the next episode will be, but I hope you enjoy this episode. Also, make sure to go to alexepstein.com and sign up for the newsletter, because that is every week. That'll give you the latest Forbes column, and that'll also let you know about other media appearances I do, such as participating on other people's podcasts, which I've done lately much more frequently than I've done my own. But we will be back at some point. So until then, thank you for listening. I'm Alex Epstein. This has been Power Hour.
Power Hour. Life, liberty, and the pursuit of energy. Power Hour. The antidote to shallow thinking about energy issues.